And a lot of you people are going to say, hey, $780 a month is not going to retire me. But you can do this time and time again, which is why it says repeat after, the buy, rehab, rent, refi, repeat. That's the last R in BRRRR, because if you do this 50 times, now you're rich.
Guys, welcome back to video, what video are we on?
6.
Six, wow. Welcome back to video 6 in this Masterclass series, all about exit strategies. So far, when we've gotten into the exits, we've talked about a fix and flip exit and a buy and hold exit using the 1% formula. And we've got Tony back here with us. And we're gonna be breaking down on this video the BRRRR method. Now, at the end of the last video we did, if you guys are following along in order in the series, we talked about how a buy and hold investor is gonna look at a deal and they're gonna analyze that deal based on their cash flow and their returns that they can make long-term, because it's a buy and hold, right? So they're not looking at how do I make a quick profit? They're looking at, what kind of benefits do I get by owning this property? What kind of cash flow can I earn? If I have cash into the deal, what's the return on that cash? That's how they're thinking. And again, the reason why you need to understand the BRRRR method, even if you're a wholesaler, you have to understand the BRRRR method so that you can have an intelligent conversation with your buyers that are buying doing the BRRRR method, which is a lot of your buyers. If you're doing buy and hold, it's a lot of buyers. So Tony's actually going to walk us through right now. And this may look like a lot, guys, on the board here, but we're going to break it down for you. If any of this is unclear, go back through again and watch it again. Make sure you understand how the math pencils out, because if you don't, and you don't grasp how a BRRRR method works, how could you have an intelligent conversation with a buyer who's potentially looking at your deal to buy using the BRRRR method, right? You won't be able to present it effectively. You won't be able to show the numbers effectively. And if you mismarket it, like we've been talking about, you're going to miss the boat. You're going to be talking to the wrong buyer, and they're not going to want your deal, and you're going to have a problem on your Dispo. Right?
Yeah. And we talk about our exit strategy, but this is an exit strategy of our buyer. And we need to know that too, because what are they going to do with this deal after we exit it to them? And we talk about the 1% rule on a buy and hold is really somebody who's buying it cash, which we get a lot of investors that are not necessarily in real estate. They're just have a high paying job. They have this huge tax liability and they're buying up rentals with cash simply for tax reasons. And they'll be doctors and lawyers and CEOs and business owners where they're just using an agent usually, and they're just finding deals for them. They're putting cash out there, 1% rule, great. I don't ever want to look at the property as long as it's making 1% a month. I'm good with it. But most of our savvy investors that are buying and holding, they're using a BRRRR method because they don't want to run out of cash. And how can they buy and hold and then take that cash that they used to buy and rehab this property, pull it out of the property, and then go do this again and again to start gaining wealth and have a huge portfolio?
Yep.
So a BRRRR method is a buy, rehab, rent, refi, and repeat. So your buyer is going to buy the property cash. They're going to rehab it cash. They're going to start renting it out. And then they're going to refinance it through a hard money lender using a DSCR loan, where they're looking at what are the monthly rents and what can we loan on this property because of those rents on a debt service coverage ratio.
Yeah, you guys hear us talk about this. DSCR, debt service coverage ratio. This is an investor loan for buy and hold investors. So it's not traditional financing. It's not a bank. These are basically hard money lenders, but they're long-term loans. They're going to let you stay in the loan, but they're a little higher interest. They want a little bit more money down, right? And they call it debt service coverage because they want to make sure that the rental income, which we'll get to, same as our last example, that can service the loan easily. And from their perspective, hey, if the rents collected can service the loan that we're providing more than 1-to-1, then we feel good because they can easily pay their mortgage payment out of the rent that they're earning. That's the idea behind. So when you hear these like debt service coverage ratio or DSCR loans, just understand what we're talking about there is a refinance loan. I guess you could do them on a purchase as well, but it's an investor loan for buying and holding real estate.
Right. And we talk about DSCR loans. It's really simple to just say it's a 30-year fixed mortgage, right? Like everybody knows what that is. So the calculations are easy on that. We're looking at what are the current rates on a DSCR. loan. In this example, we use 7.5%, and
which is going to fluctuate.
And it's over a 30-year amortized schedule. So what is our, principal and interest payments on that loan? That all comes into play when we talk about PITI. Now that's a lot of information for everybody. So we're going to break this deal down so you understand it better. And we're just using the same example as our 1% buy and hold with
which
our
was
cash
the last
investment.
video, guys. So if you haven't watched the previous video before this one, number 5, or
it was number 5, I think it's 6.
Go watch that because you're going to get a better understanding of why we have these numbers here to do this one. So the video 5, we broke it down, but we're going to be using the same exact numbers to show you how a BRRRR method would work.
And these are very realistic numbers for typical deals that we see. I see them all the time in our office. And if this deal worked at a 1% rule, let's see how it pans out on a BRRRR method, which is typically going to be our investors. So they were all in at $185,000 on this deal when that ended up being the buy and the rehab. Say they bought it 175, they put 10 into it, like our last example. They're all in cash on this deal at $185,000. Now, when they're going to refinance this property, we know our rents are $2,100 because of the last video. So we're getting $2,100 a month in rent. So they're going to refinance this through a DSCR loan, and they have to usually put down 25% on those loans. So we're breaking this down step by step on what your investor is going to go through on their exit strategy so you can talk about this deal properly with them.
And this is very typical, but it could be 20, it could be 30, but on average, you're seeing these DSCR loans, they want that investor to have 25% skin in the game. Remember, the lender on a DSCR loan is trying to reduce their risk. So if they know that you've got 25%, or in this example, that would be $46,250, that has to stay into the deal as your skin in the game.
Mm-hmm. Yeah, okay? Exactly. And that's, again, we talked about it in the previous video of getting into real estate investing with no money. I mean, you can do a DSCR loan off the rip if it's getting rent already, and you can borrow the down payment with private money, right? So that is a way you can get in with little to no money. But we talk a lot about objections in this business, and that's one of the number one things people ask of me is, can you go over objections with me? Like, what objections are you hearing from your sellers and your buyers? It's a really hard thing to script out because I get new objections every single day.
And they're all different.
And they're all different. Everybody's priorities are different. So when you structure your deal, your wholesale deal, this way and show the numbers in your listing or the way you're marketing it, whatever your strategy is, this cuts out a lot of the objections you're going to get from your buyers. Now, if this deal works as a fix and flip or a buy and hold or whatever, BRRRR method, now you can structure all those out and say, who wants this deal? You can either buy it and flip it and make money on it, or you can buy and hold it and make even more money on it, right? So it just depends on the exit strategy, but you want these numbers in your listing so you know what you're talking about, and you cut out a lot of those objections if you have the proper numbers and the proper comps supporting your numbers in your listing.
And when Tony says listing, he's talking about your Dispo packet when you're taking your deal to market.
Exactly.
Right? That could be on market. We'll talk about that soon, but when you take that to your buyers, that listing or that write-up needs to be able to clearly articulate how this is a good deal for them.
Right. Because if it's not a good deal with you running the numbers, it ain't going to be a good deal for your buyer. So you're proving to yourself this is a good deal so you can sell it to your buyers with confidence.
Yeah.
So on the DSCR loan that they're getting and they're pulling out and refinancing, ended up being $138,750, which we talked about on a 30-year fixed DSCR loan at 7.5% interest. Your monthly principal and interest payment on that loan is going to be $970, right? That's all pretty easy peasy clear. So we also have to bake in the taxes and insurance, which we talk about PITI a lot. That's going to be your principal, interest, and your taxes and insurance. So that's your all-in cost, hard cost of the loan and owning this property, right? So with taxes and insurance on this property, which taxes are public record, you guys can find that. Homeowners insurance, about $100 a month. it's $1,220 a month PITI on this particular deal. Now, as you saw in the last video, we ran comps in our heads and came up with $2,100 a month in rent. So if it's $2,100 a month in rent and you take out the $1,220 in your PITI, this property is now cash flowing $780 a month for your BRRRR investor, which just without even doing a percentage calculation, I know is a good deal in this market, because our interest rates are 7.5%, which we talked about before. It's all relative, right? 7.5% seems high right now because we were so used to 2.5%, 3%, 3.5%. But 7.5% really, when you look at the history of interest and the cost of money, not crazy, right? So right now, this deal would be cash flowing $780 a month on a BRRRR method refi. That means your yearly cash flow is going to be $93.60 on this one property. And a lot of you people are going to say, hey, $780 a month is not going to retire me, but you can do this time and time again, which is why it says repeat after, the buy, rehab, rent, refi, repeat. That's the last R in BRRRR, because if you do this 50 times, now you're rich, right?
Yeah.
So with your $93.60 cash flow per year, if you take that number and then you divide it by your down payment that you had to put down on the property, now your cash on cash return is 20%. Where else can you get 20% return on your money?
Yeah, nowhere. And guys, if you don't understand what that means, remember the $46,250 was your down payment. That down payment is the cash to get into this deal. Because remember, you financed the other $138,000 of the $185 total acquisition. So you're all in at $185. You finance with debt, right, on a DSCR loan, $138. That means you put $46 down. That means annually that $93.60 in cash flow is a 20% return on the cash that investor invested to get into that deal.
Yeah.
So that's why at first glance you're like, oh man, I got to put $46,000 down on a property to own a property. Yeah, but that 20%, that 25% down is making you a 20% return on that money, which is phenomenal.
Yeah.
We find that really anything double digits is very attractive.
Yeah. And then in 5 years, you get all your cash back and you own this property forever.
Yeah.
Right?
Because here's what could happen. You're all in at 185, but let's say in 5 years, it's worth 200 or 215 or whatever, 225. And then let's say rates come down, you could refinance that. You could pull out that cash now that you had into the deal, pull that back out. You have now a lower interest. Maybe your cash flow goes up. Maybe it doesn't change, but you pulled all your equity out. Now you can use that money to go buy another one. This is how they think. Now, it may not be what you're doing. You might just be like, Jerry, I don't really care about all this. I just want to wholesale. That's fine. But remember, the point here is the better you understand your buyer, the better the wholesaler you'll be.
Yeah, 100%. If you don't know these numbers, you're going to miss out on money and deals and becoming an expert. You wonder why you get beat up from your buyers all the time? It's because they're the expert and you are not. You're just sending them a deal at a certain price and don't know the numbers and don't know the exit strategy. The more you know these exit strategies, the more of an expert you are, the less objections you're going to get, the better you're going to get with your talk tracks on them, the better you're going to get with your calculations and understanding a deal, and the higher you're going to sell these deals at, and the more your buyers are going to feel comfortable when they get a deal from you, so they're going to pay attention to your deals. Like we said in a previous video, these buyers get 50 deals a week, 50 deals a day sometimes, and how do we stand out from the rest? We talk about standing out with our sellers by having a really good script and knowing what we're talking about to our sellers and qualifying their properties, letting them know that, everybody calling them, begging them to buy their house isn't real. We're going to qualify it. Like we're creating that, scarcity and urgency with them. It's the same with our buyers. It's just the flip. It's the other side of the coin where, hey, I'm going to send this to you this structured. And when the package looks this good going to your buyer and they give you any type of objections or price adjustments or anything like that, low offers, hey, this looks so good. You don't think another investor sees the value in a deal that is cash flowing 780 after you BRRRR it and you get a 20% return on your down payment. Like this is a good deal. You can't tell me otherwise.
Yeah.
Right?
And when you go to Dispo this deal, you're going to be talking about $780 a month. You're going to be talking about a 20% cash on cash. These are the things that at a glance, a BRRRR person is going to be like, oh, I'm looking at deals, looking at, whoa, $780 a month, 20% cash on cash. I got to check this deal out.
Yeah, let me look at the
because
details.
Because you knew how to draw out what's interesting to them and what's important to them, because you understand what they're doing by really knowing how the BRRRR method works.
Yep. And one more thing I want to touch on too is this, remember our buyer went in with cash on the 185 and then they decided to refinance out of it 75% of that money. So they're able to pull this $138,750 out and they can do whatever they want with that money. It's tax free, right? It's debt. So you can't get taxed on it. They could either go buy a Ferrari or they can go do this again on another property and again and again and again and gain that wealth. So not only are your buyers doing this, but as we start wholesaling, we start analyzing deals and understanding the market and understanding exit strategies. Us ourselves as wholesalers can start gaining wealth as well. Instead of giving these deals away for, $20,000 assignment fees, it's so transactional. When you understand your buyers and their exit, you become one of those buyers for certain deals, and you can cherry pick your off-market deals for the best ones that maybe you're going to cash flow $1,000 a month.
Well, think about it this way. Let's say that you are one of these buy and hold investors and you have 185 in cash. Let's say you pulled it out of your 401k or you cashed out a stock, whatever. You've got 185. You could dump all 185 and do one deal, and you got no debt and you got one deal. Or you could do 5 of these at 46 down a piece. So now that same 185, putting 46,000 down gets you to 5 or close to 5 deals with the same 185 by refinancing.
Yep.
So that's called leverage, guys. And that's what a lot of these investors do. They want to leverage their cash by using debt to leverage.
Yeah, debt is a huge thing in real estate. Obviously, you can't gain huge portfolios without it. Somebody's going to hold the debt. It's either going to be a hard money lender or the seller. Somebody is going to hold the debt, and we'll talk about seller financing in another video. But there is debt to service these loans, and how can you make money every single month having this debt? And how can you pull the money out and keep repeating and doing this time and time again to grow your portfolio and gain a ton of wealth? I mean, you start doing this 10 times even. That's a good, salary for somebody. You do it 20 times, 30 times, 40 times, 50 times. We have friends in the industry that have hundreds of doors that do this. We have, a friend of ours has 50 of them in Chattanooga, and he, makes 50 grand a month off of them, So it's a great strategy, and you need to understand it when you're wholesaling, when you're a buyer, when you're selling to buyers. You need to understand these exit strategies.
I'd like to take a second and thank our sponsor for this video today, right here where I'm recording at the Looking Glass Hotel and Event Center. Located in the heart of San Juan, Puerto Rico, just 10 minutes from the airport and walking distance to the best restaurants, shopping, and beaches, this newly renovated hotel is the perfect spot for meetups, events, retreats, and podcasting. So if you want to create an unforgettable experience, come to the Looking Glass Hotel and Event Center. Click the link below this video in the description for more details. Now, what's going to be great here is in the next video that we do, we're going to take another buy and hold, but rather than the BRRRR method, we're going to show creative finance. And why that's significant is because when you look at a creative finance deal, that buyer, that buy and hold investor, he's going to be comparing that deal to a BRRRR. And he's going to be looking at, okay, well, if I did this same deal using BRRRR, I'm going to have to put 25% down. I'm going to be paying a 7.5 rate. So then when you bring creative finance to that buyer and you beat those terms, you beat the 7.5 and you beat the 25% down, all of a sudden now you've got a lot of interest from the buy and hold community, because they're like, wow, you mean I could get into that buy and hold and be under 7.5? You mean I could be at 4 or 3%? And I could get all in at 20% or 15% or 10% all in. Now, all of a sudden, they'll pay a premium on the price because you made the term so attractive. Now, that doesn't make a lot of sense unless you understand the BRRRR method, because that's their other option. If a buy and hold investor wants to grow, the only way he can grow is either he's printing a lot of money and just keeps paying cash, which is rare, or he's leveraging debt, either by doing something like this and refinancing, or taking over and creating creative finance where the debt's in place.
Right. And I think in that video, we should go over sub 2 creative finance kind of in one, because you're absolutely right. This is the base to know, because this is kind of the industry's standard of, debt.
It's the comparison.
It's the comparison. This is something that everybody can get.
Yep.
Well, why are these sub 2 and these creative deals so appealing to these guys? Because not everybody can get them. There's a scarcity there. And
no qualifying.
No qualifying. They can get into a deal without a hard money or a hard credit pull or anything. Yeah. So it's those are great strategies too, and they're very scarce, which is why they're the hot topic right now with interest rates rising.
Yep.
And when you do get a sub 2 or creative finance deal, a wrap deal that you then dispo, you'll see how everybody the feeding frenzy that comes to the table on these things.
Crazy.
Especially if it beats, these numbers on a traditional BRRRR method DSCR loan.
Yep. Awesome, guys. So we're going to be rolling out that video. Stay tuned for that and be watching for that. Be sure to check out the playlist. We're putting all these videos in this series into that playlist. And guys, be sure to check the description as well. I'm going to put some information there about how you can follow Tony. You can, I want you to follow him on his socials, on his YouTube channel. He's putting out a lot of content there as well. And also check out some of his training that he's got. He's got a really amazing training on how to do all these exit strategies. And also he's got a community where you can actually work with him live. He shows you how he does his calls, how he breaks down his deals. So that's really awesome too. So check that out. Guys, let us know what questions you have. If you're stuck on any of this, keep going through this until it really sinks in and you get it. And guys, we'll see you on that next video. Thanks for joining us.